From coast to coast, we follow one principle. We go where demand outpaces supply. It's the approach behind Hearthfire Holdings, and today, that path takes us to Greater Boston, Massachusetts, where one location is quietly standing out. What happens when demand keeps rising, but supply can't keep up? What happens when over 247,000 people live within 3 miles and space becomes one of the most valuable assets in the market? What happens when you can access an opportunity typically reserved for institutions? Welcome to Malden, Massachusetts, just minutes outside Boston. This is a high-density, supply-constrained market where self-storage isn't optional, it's essential. Here, more than 57% of residents are renters. Living space is limited, mobility is high, and demand for storage, it continues to grow. This is a Class A self-storage asset managed by one of the most recognized names in the industry, Extra Space Storage, entering at over 90% occupancy, with rent still below market, meaning the upside is already built in. This is not a turnaround story. This is a capture the remaining upside opportunity in one of the most resilient asset classes in real estate, a market where supply is constrained, demand is proven, and institutional players are already active. But this isn't just storage. This is a dual asset opportunity. Alongside the storage facility sits a fully leased industrial warehouse. It is positioned within the last mile logistics ecosystem, adding stable contracted income from day one. This is a rare combination of location, demand, income, growth, all in one opportunity. Today is Thursday, May 7th, and we want to personally welcome all of our accredited investors joining us live. You're about to be guided by Sergio Altomare and Jordan Canino as Hearthfire Holdings unveils one of the most compelling self-storage investment opportunities in the market today. Let's dig in, and let's explore the full potential of Malden.
All right. So while we're pulling up the deck, this really is a significant strategy adjustment or addition to what we've done traditionally. This marks our first foray into a major MSA. Boston is the top 10 MSA nationally. We're going to learn a lot of what makes this market fundamentally superior in so many different ways. This is also our entry into what is what is starting to become a partnership between asset classes that we believe that you're going to find is going to continue to grow, and that is self-storage along with an industrial asset. Very rare that you find this combination in the market. You're going to understand why we feel that this is unique, especially considering who the tenant is on the industrial side. So this is an infill property that has almost 50,000 net rentable square feet of self-storage and 25,000 square feet of fully leased industrial triple net warehouse in Malden, Massachusetts, a few miles outside of Boston proper. The return projections on this investment are 2.2 multiple on invested equity, over 19% internal rate of return, and a 24% plus average annual return. This is without any capital improvement or development risk. First, let's little disclaimer. This is a presentation for informational purposes only and is not constitute as an investment, legal, tax, or financial advice. This is not an offer to sell, solicit, buy securities. Any such offer is made by the legal documents and solely through defining the offering to qualified investors. This is a 506C investment, meaning that only open to accredited investors. If you're not certain if that means you, reach out. We can certainly help you with that. Please keep this confidential. You may share some of these materials with other accredited investors, but this is not for general public. You are in a unique room right now as alternative investments, and in what we do is not open and available without being in the know. Projections are hypothetical. They are based on estimations and assumptions and not guarantees of any of the outcomes listed. Actual returns of any investment may differ from projections for various factors, and all forward-looking statements are subject to risks and uncertainties. So a little bit about our agenda. I'm not going to read through the table of contents there, but you could see it's an action-packed time that we're going to spend together. So first, what is the opportunity? So this is a purchase price of $22.15 million across just over $7.5 million in investor equity. I mentioned the return projections. The cumulative depreciation is 98% with a significant 85% plus bonus depreciation year one. So what are we buying here? This is a turnkey project and newly renovated by an industrial sponsor, acquired this asset, renovated the self-storage in 2025. They are an industrial investor. They placed the Uni tenant that we will talk about. And so their business improvements are done, and now they are exiting at the right time for their business. The property's been fully modernized, new roof, new HVAC system, redesigned office and lobby, added handicap accessible entrance, repaved the parking lot, fresh paint and lighting, and Noki smart lock system that we'll talk a little bit why that's important for modern day tech, AI, and behavior analytics. It's a severely undersupplied market. There's a 247,000 resident population base in the 3-mile radius. For those of you that are new and familiar with our platform, we typically look for 10,000 people per mile to consider an acquisition or development opportunity. Here we significantly have greater population density, and the average square foot per capita is 4.2 square feet of storage per person. There, the national average is 9 square foot per person, so we're less than half of the capacity in terms of where supply and demand meet. You will also learn that there's a moratorium where additional self-storage is not coming to this market. The median household income is $99,000. We typically look for assets in markets that are showing at over $50,000. The upside is already being achieved within some of the units within the rent roll. What that means is that we have identified that the revenue and rates within this asset, the self-storage side, are 10% below market, but it's already being achieved within the rent row. So the opportunity here is simply take advantage of Extra Space's revenue management program, which is best in class, capture that upside in revenue and rent, and continue to drive the market as the markets continue to recover, and we're buying it at a most effective cost basis and timely within the general economic cycle. The last part of this is, as I mentioned, it's significant tax benefits. Year one of $6.5 million of accelerated depreciation, which is 86% of invested equity, which means if you were to invest $100,000, you would get $86,000 in tax losses year one. A little bit about the highlights, the built-in diversification. I mentioned this to start. It's a dual asset investment opportunity. Just to give you a little context, last week I attended, and last month a bunch of our other teams attended a flex space conference I'm drawing a blank of where I was even at. St. Louis, sorry. So I attended a flex space conference in in St. Louis, and then our team also attended another flex space event in Atlanta last month. What was prevalent and obvious is two things. One is that the industrial asset class is growing and more attracting more self-storage owner and operators because of the parallel demand metrics that go hand in hand. Okay, so it's a very attractive basis that we're acquiring this. It's a 6.43 going in cap rate on the trailing 12 months. So this is not speculative. This is being what is we are actually acquiring it to. To give you context, a Class A self-storage property in a greater major metro is typically trading in the low fives in terms of cap rate. So we believe we're at a very strong cost basis, very high barrier to entry market. We've attempted to enter the Boston market for many years, and even when we've captured or identified development or expansion opportunities, the impediment to move forward is the time to actually get entitlements and permits. It is very, very hard. It's typically 3 years or more to be able to move a project in the greater Boston metro. And in this particular case, there's a moratorium on new development. We identified a few development pipeline projects. All of them are stalled for all of the same reasons. The supply demand metrics here are really jumping off of the page. We are 4.2 square foot per capita, which is, as I mentioned, half of the national average. I mentioned the embedded rent growth that we are seeing already in the rent roll, and then the tax shelter, as we discussed. A little bit about Hearthfire and our track record for those of you that may be new to our platform. We are 25 assets, over 1 million square feet of self-storage across 10 states. We were founded in 2012 in residential and multifamily. Corinne and myself started the firm. We had 9 exits, 8 in multifamily and 1 in self-storage, generated an over 25% internal rate of return average for those assets. Almost 280 active investors, over 50 million in invested equity, and over 200 million in assets under management. Corinne and my background go back, it's various and diverse, with myself spending over 20 years at the Federal Reserve in technology. So I've learned the economic cycle, markets, and pair that with technology, and that's how we've been able to build a scalable platform. Beyond that, this really comes down to our team. Here you're going to see some of our senior leadership team, and Pete McDaniel. Pete McDaniel has been instrumental in building our scalable development platform. He came on board to build out our construction acumen after some failed attempts with some third-party contractors. To give you an idea of our scale in terms of development, we've completed 7 expansion and ground-up projects over the last 10 months. Pete has recently joined and been promoted as our COO, and now is driving operational excellence across the country. Prior to joining Hearthfire, Pete led the extra space development division for the Northeast and has extensive experience across development. He leads a team of development professionals on our team that are second to none. I'll save Jordan to introduce himself. Steve Good recently joined us as our Chief Acquisitions Officer. Steve comes from TerraCap, based out of Florida. He started with a firm that had 70 million in assets under management and grew that portfolio to over 3 billion. He brought in the expertise in identifying the cream of the crop, these assets that are truly institutional class, and being able to get us to access these major metros. He leads a team of analysts and investment analytics that really go into everything we do in delivering the opportunities that you find today. He's also a U.S. Army veteran, as you can appreciate the discipline and commitment to service that we have there. Jordan, you go ahead and introduce yourself.
Great. So I run our investor relations and capital raising platform. I've been in the storage space for about 10 years and in real estate overall for 15 years. I thrive on relationships and making my investors and partners, money every year. And so that's a little bit about me, and let's continue here.
One thing worth sharing about the rest of our team is one of the big things that Corinne and I've learned over the years is the when we started, this was all a technical, it was all investment thesis. Now, the biggest investment we make is in people, right? When you're evaluating a firm, you're evaluating a sponsor, it's not just myself, Corinne, it's really who are the people we surround ourselves with. If you haven't had the pleasure to meet and get to know Jordan, incredible family man. He approaches every relationship with the highest level of standard. And it's been truly an honor working next to Jordan as he embodies everything that we've become as a company, which is truly providing institutional investment opportunities that can be accessible to anyone, regardless of where you come in your investment journey. So that is really the core belief and values commitment that we have across the company.
Thanks, Serge. Appreciate that.
So a little bit about our growth. Here you just see a timeline of our entry and exit in multifamily. That really came from my ability to read, not time the market, but read market cycles. We entered self-storage at a time where I saw the investment in self-storage as a data business with a real estate component. We didn't enter self-storage as a pure real estate play. We recognized the ability to roll up assets and really the correlation to data and how that translates into an essential service for business as the economy and housing affordability continues to squeeze families. Self-storage becomes a necessary component within the ecosystem of lifestyle. And that really is what brought us into it. Now with the dawn of AI and how it's so prevalent within real estate and now within self-storage, the capabilities that we have with pricing, with revenue management, behavior analytics is really, we're just really scratching the surface. So we entered development to be able to build and scale a platform to take things from the ground back in 2021. And now we've already proven our model, exited our first self-storage asset back in 2022. And now we're in the process of refinance and recapitalizing a portion of our portfolio as we prime ourselves for the next growth cycle within the industry.
Yeah, and I'd like to mention that if you look at the beginning of our self-storage days, a lot of the stuff we did was more rural, some drive up, less institutional quality. And the stuff we're doing these days is really Class A, multi-story, climate controlled only in larger markets like this Boston market. So, an evolution of the company and just maturing as a company as a whole.
Yeah, it can't be understated what we've seen recently when interest rates shot up back in 2022 and 23, that asset class matters, right? It can sustain fluctuations far greater. And so that hence why we've continued to increase the caliber and quality of assets that we invest in.
Great. Thank you for that, Serge. And thanks for the kind words. Yeah, I'm going to dive right into the property. As you can see, it's about 6 miles north of downtown Boston. The total land area, which we'll get into in a second on the site map, is about 4.65 acres, which is made up of 50,000 square feet of self-storage, 25,000 square feet of industrial warehouse. The storages and the industrial are both 100% climate controlled. Physical occupancy is around 90%. And this building was built originally in 79 with the renovation starting in 24 and being completed in 25 last year. So the asset, Serge mentioned this, but there's really minimal CapEx here. The largest R&M line item here is snow removal, right? Because it's really a super clean, newly renovated and fresh asset. Here's the site map. You could see, I don't know if you can see my cursor, but on the left side, you have the storage. To the right side of the building, you have the industrial. The drive aisle is to the right. And then if you look in the back left, we didn't underwrite to this, but there would be a potential to do some drive up units there, portable units that you can bring in, don't have to pull a permit. So that's just something that you could see here. It is wider than it looks like in this picture just because it's very long and skinny, But yeah, it's just potential opportunity here, and I'll get into it, but we're going to be adding solar to the roof here. And as you can see, it's a very large roof. But yeah, this is, in the middle of Malden, surrounded, as you look at the map, by a lot of single family houses. And as you go a mile out and in a slide later, there's a ton of multifamily in this market and apartment renters. Here's some more pictures. You can see the renovation. You can also see from the back what it looks like for the industrial tenant and the loading dock. Super clean asset, well situated, and brand new. Some interior photos. You can see the Noki locks on the doors. You can see the office to the top right. And then here's our industrial tenant, Uni Uni, which we'll also get into shortly. Extra Space was brought on, and I'll answer one of the questions that was asked in the chat. So Extra Space was brought on by the seller from a mom and pop operator at the end of 2024. So Extra Space is not the seller. They were just their third-party manager. We already have an existing relationship with Extra Space. They manage a significant chunk of our portfolio. So we have good confidence they can execute on the business plan here. They are the #1 operator in the United States. Their revenue management system is unmatched and unparalleled. So we're really excited about them helping us drive both rent and the rest of the occupancy. We're very confident in their execution. We also know that they have one of the most recognizable brands in storage. So super stoked. We also don't have to spend the extra dollars to rebrand the facility and add additional signage that's not Extra Space. So saves us some dollars and some efficiency when we talk about turning it over from the seller to us.
One thing I can mention real quick that I see also that was in the chat is regarding performance. So typically it's usually 24 to 36 months once a property is taken over where you get the occupancy stabilized. In this particular case, occupancy is stabilized. We're at 92% occupancy. So the way the revenue management program from Extra Space works is you drive occupancy and then you push rates hard. So the reason why we haven't captured all of the income is it has only been a year since Extra Space has effectively been in here. So they've gotten the occupancy. Now the drive is to push those rates. We believe that the assumptions that we have, which is ECRIs of roughly about 10% per year, that is when it's usually a 699 program where first 6 months is when a renter gets or a customer gets their first rent increase, and then every 9 months thereafter. With the supply constraint in this market, typically it's 12% in a normal cycle. We underwrote to 10%. That's based on what we're seeing across the portfolio today, but we believe that we're going to outperform that. So our underwriting is assuming a lower than normal rate increase, and we're already seeing those higher rents captured, and really the rest of it is really just making its way through the lease timing of the tenants in there, if that makes sense.
Yeah, Boston as a whole, top 10 MSA, a leading life science and pharmaceutical market, the #1 pharmaceutical market in the country. A lot of tourism, especially in the summertime here, and it's a global financial center. So there's a lot of banks headquartered here. I don't think we need to talk about Boston too much. I mean, I think everyone on this call is pretty familiar with Boston as a market. From the storage side, what people might not know on here is that Boston is a very tough market to transact in. People don't generally sell. There's very few trades. And when things do trade, they really, they go for a pretty good number. There's a moratorium. Another thing to add about the specific market that we're in is in 2023, there was a moratorium on future self-storage. So if you had not applied for storage prior to that date in 2023, they're not allowing any future storage for the time being. We don't know how that's going to play out, but as of now, no new competitors can come online, and you would have had to start your approval process and your permanent approval process basically prior to that date. Worth
Yeah, worth mentioning there is in our due diligence in terms of the development pipeline, we did identify at least two other potential new storage developments in the market. We literally actually visited the sites. They are completely stalled. One, we're aware there are some environmental issues with the site. It has traded hands a number of times and continues to stall. We have no reason to believe that that's going to come online. But even with that supply pipeline, we're still nowhere near scratching the surface of equilibrium. So that is where we have a supply. There's a moat around the demand, and that we believe is significant. We've seen this play out time and time again in markets.
Yeah, absolutely. And the other thing to add is there's a high renter population in this market, which is a direct driver for self-storage. You know, the average apartment, 800 square feet, no basement, no garage. We look for high renter markets, and this market specifically, this sub-market is high on that. And so it's just a good driver for storage for us. Yeah, I mean, on the industrial side, the vacancy in this market is about 5% or sub 5%. Really a hot industrial market, especially for last mile logistics tenants, because we're very close to I-95 and a lot of corridors that take you both north and south and east and west. So, you know, really, really comfortable with the supply and demand around the industrial component. It just adds to the value of this property as well. Here's another map that shows you, you know, really the local towns: Malden, Everett, Revere, with Melrose to the west. Major employers here, as you can see on the map, you have Mass General, Wayfair, HubSpot, a bunch of pharmaceutical companies. And yeah, like I said, healthcare and education are huge here. The financial is huge here. Not so far as the Encore Hotel over here, which my friend who's high up in the pharmaceutical world always stays in. So he was pretty familiar with Malden when I mentioned this project to him. But yeah, I'm sure most people
One thing worth mentioning here. So when we look at markets, you've heard me, if you joined any webinar previously, you know that I talk about immutable characteristics of a market. Like, not that there are fads where people come and go. I mean, you see that sometimes in some Sunbelt areas where people go for one reason or another, right? So via air, land, and sea, the Boston market is a logistics major hub. Jordan mentioned this earlier, but I believe it can't be understated. From a healthcare life sciences perspective, the Boston market is not just prominent nationally, it's the #1 life sciences healthcare center in the world. All of the drivers, and we're going to talk a little bit about the average rent for 1 bedrooms and 2 bedrooms in the immediate market, but that's where the fundamentals here have been, going back through the history of our nation to today, continue to be strong.
Yep. So here's a local multifamily map. All of these 6 apartment complexes are within a mile of the site. The total units around just north of 1,000 units of multi in this area. So very strong renter population. And, you know, we love to see this when we look at a new opportunity. If you look at the site itself, it's surrounded by single family to the, you know, the direct north and west and southwest. And then as you go a little further out, multifamily. To the right is landlocked, and there, you know, it leads out to the water. So there's really nothing over there. But yeah, super dense market and surrounded by a bunch of multifamily, which we always love to see. And Sergio will add a little bit more to that.
Yeah, what we're seeing is a 1-bedroom apartment in these specific apartment communities here. A 1-bedroom, the average rent is about $2,700 per month, and an average 2-bedroom is $3,500 per month. And these are not big apartments, hence the demand and the lease up velocity that was already achieved with this asset.
Yeah, Gary, I don't know the elevation above sea level exactly. It's probably if I had to guess, sort of 30 feet. But if you look to the east of the asset, that's an Amazon warehouse, right? So that speaks to the quality of this market. You know, we've done all of our third-party reports on environmental and you name it, we've done it all. But when it comes to feeling secure about the market and the asset, it's always good to have an Amazon warehouse, multiple 200,000 square foot Amazon warehouse directly next to the facility.
Yeah, that speaks to the logistics where it makes sense. For those of you, and we're going to talk a little bit more about Uni, they are a rapidly growing last mile delivery. So they're pairing nicely with next to Amazon, and they service two different types of e-commerce clients, hence why there's not really competition between them.
Yeah. Here are some of the rank comps within a mile, 1.25 miles. If you notice, 2 of the comps are extra spaces. We like that because there's no one that knows this market more than Extra Space. So if you look at all of our rents, we're slightly below, but the 10 by 10 units we're significantly below. So we're going to be able to drive rent there. The other thing that helps with having extra managed facilities within a 1 to 2 mile radius is in the event that someone shows up to one of these other facilities looking for a 10 by 10 or a 5 by 10. And if they are out of those units, we're almost like an annex in that regard. And someone would probably come, they would stay within the Extra Space ecosystem because all of these facilities talk, and it's a real benefit to going into a market with the market leader. The other thing to note here is all of these assets in the immediate area are pretty institutional in quality. So the quality here is good. The pricing is tight. And so we're really in a strong market with very little mom and pop. There's going to be nobody here to undercut rents. And as the tide rises in storage, we're going to be able to ride this market and these competitors as well.
Question came in about the sea level and concerns about global warming. So one is we're about 30 to 50 feet above sea level here, and we are not in a flood zone. Beyond that, those are, can't speak to risks, et cetera, but there is no history of damage or issue related to water at the property.
We talked about this at the beginning, but the general business plan is buying this asset at a very reasonable cap rate, attractive to us, and we'll be able to yield our investors good returns from the beginning, marking the rents to market. So driving those rents and getting them up to market. Like we mentioned before, Extra's only really been in here for a year, and it takes some time to do that, but we're very confident in them being able to take these rents up to where the market is. We're not, we underwrote to about a 2% rent growth in year 1, and then years 2 through 5 around 3%. We find that's pretty reasonable given what the market is supporting here, and where rents are in the market. In addition, we're adding the solar panels to the roof will bring us about $65,000 in revenue to us per year. There's no cost out of our pocket for that. A solar developer comes, develops it. It's already under agreement, and the lease is being transferred to us. It comes in the form of a lease payment, and it's a 20-year lease. So we're excited about that. I also mentioned the drive-up units in the back, which is a flexibility that we have for the asset. We're then going to harvest the dual income, 3% rent growth per year on the industrial tenant, plus the rent growth that we spoke about on the storage side. And then we're going to exit the asset. By the time that we exit the asset and we mature the asset a little bit further, we feel that a 5.5% exit cap, we can't predict interest rates, but we have known that interest rates have been pretty flat here for a while, and cap rates follow interest rates pretty good. And there's a little bit of a lag, maybe 9 to 15 months on that. But if interest rates ever tick down, cap rates follow, especially for asset classes like these that are institutional in quality. So, maturing the asset plus some compression in cap rates based on interest rates gets us to the returns that we mentioned before. Serge, anything to add there?
No, I will say that the dominant, and I speak with brokers, commercial real estate professionals, all day, every day. The consensus is that commercial real estate has been in a recessionary environment for, over 3 years. Transaction growth or transaction volume is very low. We believe that we are buying as close to the bottom of the market as you can get, notwithstanding, the global instability and the wars and, oil shock and all of that. There have been a lot of signs, green shoots suggesting that we're about to hit another growth cycle, whether that happens this year or next year. Our model with this project is we're planning for 5 years. In 5 years' time, of course, anything can happen, but we are looking to capitalize on the next growth cycle.
Here's the sources and uses. We have 67% debt lined up. That debt is 5-year debt, interest only in the low sixes, probably between 6.1 to 6.3, depending on where the 5-year treasury is. Us, Hearthfire, will be putting up 3% of the remainder of the equity with 7.3 million left for our limited partners. I'll get to this in a slide, but to date, we have 3 million committed for this project prior to the webinar. That's is made up of our existing investor base and some folks that have been waiting for a deal that has cash flow like this on the sidelines. So in addition to that, our closing costs are just shy of 1%. We're going to have an interest reserve of about 110,000. Our AC fee is 1.5%, and the debt origination fee to the intermediary is about 155,000. I mentioned the interest only, which allows us to have good cash flow to pay day one. Our leverage being right in kind of the range that we like to be, shy of 75%. And the debt service coverage from day one, which the bank requires to be 1.25, is 1.5. So there's plenty of cash flow to support the debt service here.
Yeah, it's worth noting that this is a year one cash flowing asset to investors. I'll mention this now, and we could reiterate this later, that typically we stabilize our management of the asset. So cash flow, when we say it'll be cash flowing day one, distributions typically begin the first full quarter post close. So if we close in July, it'll be the rest of that quarter and then following the first full quarter. And this is for it to normalize our management with Extra Space. We don't anticipate anything off the wall, but by the time we get the books and the accounting function operational, that's how we are simply able to just make sure that we hit our debt covenants. The other factor to consider that really is a significant achievement for us is in the financing. That can't be understated. Our capital markets team is, I think they're second to none. The competition for financing this deal has been excellent, right? We've been able to source financing directly, and this is institutional type of financing. It's a balance sheet investment. We'll mention the lender as that gets solidified. We haven't executed. We're about to execute the term sheet. Don't want to mention that on a recording, but it's very strong financing from a very prominent top national institution bank.
Yeah, absolutely. And Jason, just a quick response to you. Yes, if we cannot fund the project, we would not just take your money, you would get your money back. And the other thing is that we have 2 JV partners that come in for normally north of $1 million on each project, are looking at this deal very closely. So there's a good chance by the end of this week, we're at $5 million. Here's a little bit more of the breakdown in the fees. So as you see in the middle, our minimum investment for this project is $50,000. Our total investor equity was 7.3, and we're left with 4.35, which I had just mentioned. Our AC fee is 1.5%. Our asset management fee, which is a function of the revenue of the project, is 1.5, all pretty much industry standard in our space. And the disposition fee is 1%. The other thing to mention on this slide is that you're able to invest through your personal name, you and your wife's names, your significant other, through an LLC, a trust, where this deal is 1031 eligible. You're also able to invest in this deal through a self-directed IRA. Yeah, that's pretty much this slide. If you have any questions about this slide, feel free to put it in the Q&A or add it in the chat. Here you go, Serge.
All right, so let's talk about Uni Uni for a moment, right? Prior to us, discovering or uncovering this asset, we didn't know who Uni Uni was. As we've been doing due diligence, what we've learned is Uni Uni is a last mile logistics delivery service that is a disruptor in the industry against FedEx, UPS, and the like. They've grown over 7,000%, just about 7,000% in revenue in the last 3 years. They are venture capital funded. They support services like Temu. We just learned TikTok, where Pete got something delivered for his daughter just yesterday, and it was delivered by Uni Uni. They're based out of Vancouver. They are expanding rapidly in major metros across the US. We believe, and we're still in due diligence, we have an interview with Uni Uni over the next couple of weeks to understand their business plan. What I personally believe is that long landing strip piece of land that we looked at earlier is part of the business plan. Basically, you could think of semis show up with pallets of goods, then independent drivers come and take them and do delivery. Again, this is e-commerce. This is a discount chain. They have a network of major e-commerce contracts that they work with, and it's a rapidly growing and expanding business. We understand they're heavily investing in robotics and a significant player within the industry. So when I take a step back and I say, and I look at this opportunity, and knowing that we've got the Amazon warehouse next to us and this lease in place, I think it's a significant advantage, right? It speaks to the volumes of a company that is venture capital back and identifying this location. So I don't think it can be understated as to the opportunity that we have here. Their in-place rent is below market, but when you factor in the parking in the triple net part of it, it's about at market. 5-year, 3% annual rent growth, and then an option to extend on the back end. So we are, this is a class of tenant that is newer. Some of the more, older institution may consider that new tenant risk. We think of it as new tenant opportunity and a disruptor in the industry.
Here's the 5-year pro forma. The main thing to take from here is that you see in year 2 the additional 65,000 from the solar. The other thing is, if you take into account the solar, we're around 1.5 million in NOI, and we're driving it to 1.786. Basically increasing it by around 5% with maximizing the revenue and the expenses. So not a super heavy lift here. Our in-place NOI is roughly 1.44. So you're talking about year 1 keeping it pretty flat. And so, yeah, we're really excited about a deal that doesn't require such heavy lift. And for folks that have invested in a development project of ours, we think this is a good benefit and a good additional investment to diversify within our portfolio. Here are the projected returns, and I'll get to a lot of the questions that people have been asking. But as you can see, the cash on cash return, this is a percentage of your invested dollars, the cash on cash return row. And we have a cash flow example after this, but it starts around 6% in year 1, paid quarterly, goes all the way up to about 10% in year 4, And then in year 5, it dips down a little because we allocated some additional funds to renew the lease of Uni Uni in the event that we had to go through the broker. We're obviously going to try to go direct, but on erring on the side of conservative underwriting, we kept that in there. Our waterfall for this project is a 10% preferred return, which will accrue the minute that your money hits our account and we have accepted it. And then you are owed an annual preferred return of 10% each year. After the 10% return, the next hurdle rate is 18%, which is split 75% to you, the limited partner, 25% to us, the general partner, and then above an 18% return, it's split 50-50. So for us, we're really trying to exceed that 18% return, which is where we get the bulk of our profits on the project. Anything else to note on this page, Serge?
No, I think if you look at the waterfall structure, if you're new to alternative investing or real estate passive investing, it's really the big difference between traditional and conventional investing is alignment of interest. As you can see that the lean to investors with the 10% preferred return and hurdle, we're highly incentivized to perform, right? If we don't perform, then this is a loss for us. The way that I always like to think about this is your tolerance should be a 10% preferred return. That is kind of our worst case scenario when we look at an investment, is if we don't hit the preferred return, then we don't perform against other alternative or traditional investments. So the alignment there is strong. That's what we pride ourselves. We pride ourselves on providing a scalable investment platform. And so I think it's worth comparing the splits here to any other investment out there.
Yeah, absolutely. Christian, the snow removal will be in repairs and maintenance. The minimum investment is $50,000, self-directed $50,000. It doesn't matter if it comes, $50,000 is the minimum no matter where it comes from. So we'll just move on here. Here is a cash flow and depreciation example. So on a sample investment of $200,000, you're looking at the following distributions, which are paid quarterly. So that is your annual return. You just have to divide it by 4 to figure out your quarterly return. You would get your return of principal upon sale. And then as you can see for this project, you get back $156,000 in profit from the sale when we sell the assets. So significant distributions and cash flow along the way, return of principal and additional profits on sale. That yields you roughly a 20% IRR and 24% ROI or AAR for this project. Next, the depreciation. Most of the projects that we do are generally between 40 and 60% in year 1. This one is about 86%. So on a $200,000 investment, you're able to utilize $172,000 of tax losses to offset your other passive income. The key here, it cannot offset W-2 or 1099 income. It can only be utilized against passive income. So I know someone asked that above. So that's in a nutshell this project. In addition, on the cash flow side, you will receive roughly 3% each year in additional depreciation. It's important to note that the depreciation not only can be utilized against the rest of your passive portfolio, but it can go to offset your distributions from this project. And it can be carried forward. You don't have to use the 86% in year 1. You can carry it forward over the life of the hold. So, really strong cash flows, really significant tax shelter here, which speaks to why we raised, $3 million over the course of basically a week since we sent the first email.
So Gary, I see your question regarding the preferred return of 10% per year. So this is showing the anticipated actual cash flows. The 10% preferred return accrues whatever is not paid out, meaning that if year 1 it's a 6% distribution, then 4% of that is accrued. In this particular case, in the profit of, correct me if I'm wrong, Jordan, but in the profit from sale includes the accrued preferred return, correct?
That's correct. The profit from sale includes the accrued preferred. Yep.
And one thing also worth mentioning, we get this question a lot, is why not hold it forever, et cetera, et cetera. My general, and I serve as the chief investment officer here, so it's kind of up to me to help with utilizing the input of the team and evaluating the markets as to how we position assets when the time comes to harvest returns. So in general, it's a 5-year time horizon. The first 3 years are exiting or executing the business plan, and then the last 2 years are maximizing and trying to time and prime the peak of the market. As we do that, we look at what is the highest and best opportunity for the investors and the asset. The reason why I bring that up is, as we approach year 4, we will evaluate the market. There is always an opportunity for us to refinance. At that point, we would provide a liquidity event to investors and may consider holding it on. We have in the past created a new investment from existing investments, meaning that we refinance a project, and if an investor wants to quote unquote cash out, they are able to do so. But if we think there's another opportunity for another 5 years, we will do so. But the timing usually coincides with the financing term that we get with the lender.
Yeah, let's try to cruise through here, Serge, because there's a couple questions in the Q&A, and I know I don't want to keep anyone for much longer than an hour. So, and this deck will be shared with all of you. You can ask questions to us via email. I'm always available via text. Click on my calendar, book as much time as you want with me. But yeah, I mean, as you can look at the sensitivity analysis, it shows some downside scenarios, and if we outperform, where the multiple and the IRR kind of shake out. This project being really close to fully stabilized and a simple business plan, the variance is probably not going to be super wide here, we would advise, but happy to answer any questions about this going forward.
Yeah, and the sensitivity analysis there, you can see the downside risk on cap rate bars. I know you asked that question on cap rate and exit cap and revenue in terms of multiple and IRR. You can see the top left there. Obviously, anything can go out of bounds here. We don't have any reason to believe that that's going to be the case when you look at forward curves and revenue projections, which, by the way, we have from Extra Space as well, 5-year plans. Okay, the tax benefits, I'll blast through these real quick. Full pass-through, so the cost segregation study, all of the tax losses are passed through to limited partners, not through the general partners. Cost segregation study, it will be completed shortly upon closing on the deal. That is obviously for the 2026 tax season. The 86% bonus depreciation, as we mentioned. In terms of 1031 exchange eligibility, that will only come into play if someone there's a $500,000 minimum where we would consider the exchange, and it has to be timed within our closing timeline. Cohn Resnick is our CPA. We're looking to get them on a future webinar to go through some of this in greater detail.
Awesome.
All right, so the project risks, rent growth risk. This is obviously a risk in anything that we do. In-place rents are 10% below market, and future growth depends on Extra Space's revenue management execution. As I mentioned, we expect this to be a conservative view, but the mitigant is already that the asset is 91% occupied, so the only thing that we can do is push rate, which obviously leads to some vacancy, but with it being fully stabilized, we see this across other assets that we have, especially in Oklahoma, where we've been pushing rates really hard and are dominating the market because the occupancy and the demand is there. Interest rate and exit risk. I won't go into crystal ball in terms of where we see interest rates. Obviously, anything can happen, but we think it's more of a factor of oil shocks, inflation, than we think of it as in terms of overheated economy. We actually believe that interest rates are going to remain relatively flat or trading in or a small band over the next few years, and that's how we have the assumptions here. New supply risk, we talked about that. You could add significant more supply in this market and still not be at equilibrium.
Great.
Here's you can scan this QR code. It will take you to the full investment offering page where you can download the slides, review, watch the video, schedule a call, and submit a commitment. If you are interested, please go through that process. We expect this one to fill up pretty quickly. Here's the next poll that we have. This helps us with follow-ups, right? We obviously, if you're very interested and want to speak with us, we'll make it a priority to get you on a call. I'm going to jump to the Q&A. Have you reviewed Uni financials, runway analysis? That's under works. We are nailing down the contract right now. The PSA is expected to be signed today or tomorrow. Uni has indicated that once that's done, they'll play ball and be able to review. We'll be able to get into all of that. Next question, current 90% occupancy based on the trailing 12-month average. That 90% occupancy is as of today. The projected 92% occupied compares to be typical stabilized self-storage. Typically, we typically stabilize 91, 92%. So that is very common. In this particular asset, we fully expect to maintain stabilization at that time. And we're looking at it as an average per year. So we may end up hitting 95% during the summer and then come back down. What assumptions do we have to support this? This is combination of extra spaces projections, and then obviously our experience within the asset class. Next question, third-party valuation or appraisal report completed for the property. That is pending. As we solidify the lender, then they are going to require the appraisal. So that is going to be forthcoming. And I think we captured all of those questions there. I will answer, let's jump over to the chat and see if there's anything else. And let's see what we got. How long has the facility been operating when under mom and pop owner? Good question. I don't know if you know the answer to that, Jordan, before.
It's been a storage facility for a while. The building itself and the envelope is from 1979. I think prior to the storage, it was all warehouse or industrial. What's valuable to know is that the seller came in and put $4 to $5 million into the project to improve and make all of those updates, but also get the warehouse component of it ready for Uni. So, all of it now for us going forward, it's pretty much turnkey. And then for extra space being in there, it's been roughly a year. So we see the opportunity there as well.
Question regarding provide information on the exit strategy. So by today's standards, a pure institutional investor, they favor independent asset classes. Our view is this: we are seeing self-storage and industrial converge, right? We are seeing that industrial self-storage investors are going to industrial and vice versa. When we underwrite this as two separate asset classes, we do land with an industrial cap rate around 6 to 7%. When we underwrite the self-storage side of it for this asset class in this market is about 5%. Blended, our forecast is in 5 years that convergence is going to be there. We are also evaluating Uni as their growth continues. There's no indication that is going to slow down or change as they are growing right now today. So our forecast 5.5 cap in a market that can't achieve any more supply as the asset classes continue to converge. We don't believe that is a stretch at all.
Yeah.
Question, is there any UBTI or UBIT exposure using a self-directed solo 401k? There is. Our recommendation is continue to convert those assets within the IRAs. Encourage anybody considering that to talk to their tax advisor. And as we mentioned, we'll likely have Cohn Resnick on in a future call to discuss that as well. We don't pretend to be tax professionals and wouldn't want to speak to individual situations, but it would be subject to UBTI and UBIT.
Yeah.
Sharing recording, yes, absolutely. You should get the recording probably within the next hour, and then we will share it again with another email probably in the next 24 hours as well. Great questions.
Yep.
Other questions? I see some folks typing. As I mentioned, this is with the way the market is, we don't expect more than one or two additional opportunities over the next few months. We have a pipeline coming out, but in terms of this type of asset, we're looking at more flex space as well. And so if you're interested in a high yield, high growth market with the tax incentives, this is the right asset. If we aren't an accredited investor, how do we do that? Philip, if you kind of, that's more of an income net worth conversation, reach out separately and we can maybe chat about how you get there and some other options. We know some folks that partner with some other investors to be able to achieve that status. Not seeing any other questions. Feel free to add anything and we can get to it. Otherwise, there is an encore presentation this evening at 7 p.m. We'll be going through this material again. If you've got an opportunity to join, do so. If you are interested, please submit a reservation. It's non-binding. We are in the process of getting the subscription booklet finalized, the full offering set up. It's reservations that is, as I mentioned, non-binding at this time. And then you can obviously get the details, schedule a call, and make a commitment. So appreciate everyone's time for joining us. I look forward to joining us in this opportunity.
Thanks, everyone. Pleasure. Talk to you all soon.